Welcome, everybody, to another Real Talk podcast. Today, I have Mr. Jay Deahna from BWG Strategies. Thank you for coming in today, Jay.
Thanks for inviting me, Rob.
Yeah. We've connected ourselves. I know we connected on calls, through strategy calls, executive calls, especially this last year through the supply chain and all the processes. So why don't you tell a little bit about yourself and your history and background and how you actually ended up here at the Real Talk?
Absolutely, yeah. Rob. Thank you so much. So I got an MBA in the early 90s, and I wanted to be in the equity research industry. Mm-hmm. And I ended up getting a job as a research assistant at Prudential Securities in their equity research department in San Francisco, which is kind of their technology-centric headquarters, kind of a sub-headquarters for equity research. And at the time, I just randomly ended up on a semiconductor team.
Oh, wow, okay.
Could have been anything. Yeah. I just wanted to be in equity research. Could have been cosmetics. And I worked for a year as a research assistant, and after a year, they promoted me to junior analyst. And so for 3 years, I worked in a support role perspective, and it was very interesting. You know, in the early 90s, it really wasn't that far away from the 60s when the semiconductor industry came of age, right? Mm-hmm. You know, the integrated circuit was invented at Texas Instruments, and then Fairchild, of course. Robert Noyce invented the planar processing technique for producing, fabricating semiconductors, and you know, then everything goes from there, right? AMD, you name it, right? Everything. You've probably seen that flow.
Well, it's a launch pad. 90s was the kind of launch pad for technology and the World Wide Web and internet.
Exactly. So I remember my first day on the job as a research assistant. I met Bernie Vonderschmidt, who founded Xilinx. Mm-hmm. I met Wolf Corrigan, who founded LSI Logic. I met TJ Rogers, who founded Cypress. It was an amazing time. It was like that bridge between what we have now and what we had in the beginning, right? And then after 3 years, I went into what they call the Emerging Analyst Program at Prudential Securities. And I subsequently launched coverage in late 95 as a senior equity research analyst covering the semiconductor capital equipment industry.
Why don't you break down a little bit? I think a good question is, as an analyst, what is your job? Because I think a lot of people know this is a basic, okay, you're analyzing numbers. What are you doing? What is that? What was your core duty as an analyst in these roles?
Sure. So just to finish that last part real quickly, in 96, I went to Morgan Stanley. And for 4 years in the late 90s, early 2000s, Mark Edelson, who covered semiconductors, was the number one ranked analyst on Wall Street for those 4 years in a row. I was the number two ranked semi-equipment analyst. So for 4 years in a row, we're their highest ranked equity research team covering chips and equipment in history. And then in 2002, I went to JP Morgan and stayed there for about 7 years. And in one of those years, me and the semiconductor analyst there were both number one. It's the only time that ever happened. But anyway, the role of a equity research analyst, it's a multifaceted role, and it depends on where you're doing it. Are you doing it at a pure research shop, or are you doing it at an investment bank? Okay. Or are you doing it in a mutual fund? So my side was the sell side. So I was an investment banking sell side analyst. And so our primary objective, there's a lot of different ways to peel the onion. Some sell-side equity research analysts are known as stock pickers. Some are relationship people, and some are deep fundamentalists that are sort of like educators, right? And so the average buy-sider, which would be a money management person, right, mutual fund, hedge fund, et cetera, they usually have 2 or 3 analysts that are their favorites that are typically on the bullish side, and 2 or 3 that are typically their favorites on the bear side. Because what the investors want to know is, what's the bull case, what's the bear case, what do I believe the case, and then I'll look at valuations, right?
You know what that really brings to the point is in anything, you need to understand both sides to be an expert, to make a decision, an analytical, critical decision. So you have to understand the bull and the bear side, what the fundamentals, and then at that point you can make a calculated decision because you'll be biased. You'll have bias over one side, right?
That's correct. Yeah. And a lot of times, as I traveled the country and traveled the world and visited with money managers, I would sit down in a conference room with a bunch of analysts and portfolio managers, and usually the first question would be, what's your call? Right? So are you bullish? Are you bearish? Short term, medium term, long term? What stocks do you like? Right? Because at the end of the day, the portfolio managers are asset allocators. So they're either overweight or underweight tech, right? And then within tech, they're overweight or underweight or market weight different segments within tech, right? So let's say a portfolio manager decides to flip from an underweight or a neutral weight to an overweight on semiconductors. Well, then they'll bring in a semiconductor analyst and go through the fundamentals of the industry. Where are we in the cycle? Who's gaining share? Who's losing share? Which technologies are coming up? Which technologies are going down? Who's got the best management, right? But at the end of the day, management, market share trends, and being either creating or being ahead of a technology curve are sort of the key attributes, right? And then at the end of the day, you're building a model and you're looking at future cash flows and earnings, and you're discounting that back to the present, and you're saying, does the stock accurately reflect that? Does it underrepresent that, or does it overrepresent that? And that's sort of your buy, hold, sell decision.
Yeah, I mean, it's such to some people that, they don't understand the language. Some people out there are like, okay, wow, because the stock trading Wall Street, the process analyst, this is a new language or a new demographic to most, I would say 99%, 98% of people out there. They don't understand the fundamentals of how everything works because it's fast paced, it's processed, there's a lingo, it's a whole different culture.
That is true. Yeah. Now, the other thing, too, is what's very interesting about the semiconductor industry is it used to be hyper-cyclical, right? So semiconductor stocks would go up 10 or 20 times in an upcycle and go down 80% in a down cycle. And that was sort of a reflection of the fundamental cyclical volatility in the industry, right? It was a supply-driven industry. The demand drivers were relatively narrow, right? So you'd have, for example, 10 DRAM companies all building fab capacity to service 20% of the industry.
Yeah.
And that would result in these massive periods of oversupply, right? And major losses and, tearing companies apart, right? And so what happened is that semiconductor stocks and semiconductor equipment stocks used to have pretty mundane valuations, right? But then over the last 10 years or so, there's been a major consolidation in the industry, both semiconductor equipment and semiconductors, and there's a lot less crazy speculative capacity expansion, and the amplitude of the fundamentals has stabilized significantly, and the breadth and the depth of new demand drivers has just done nothing but get better, and we can talk about that separately. But what that has created is a more predictable, long-term cash generation and earnings growth scenario. And stocks love predictability. So the multiples or the valuation on chip and equipment stocks have gone through the roof over the last 10 years or so, right? Totally different scenario. Now, the other thing, too, is never underestimate the valuations that people will put on high growth companies, right? .com boom, companies making no money, but they were supposed to grow forever, right?
Correct.
Crazy valuations, right? You look at AMD and Intel today. AMD's valuation just blows away Intel, right? And I've hosted forums with BWG Strategy where I work, where we'll have executive participants from our industry on one side and institutional investors on the other. And in recent calls over the last couple of weeks, a lot of the executive participants expressed shock and dismay over how high AMD's valuation is and how low Intel's is, right? But Intel is viewed as a quote-unquote value play now, and AMD is viewed as a growth play. And so the multiples that investors put on growth companies don't make sense to traditional value-based investors.
So what's the difference? I mean, you see there's growth and value. Is that why I want to go long Intel and short, meaning like short play on AMD? Is that how would you reference that? How would you say that?
So I would say that there's probably three primary categories that people look at with tech stocks and stocks in general. You got growth, you have value, and you have GARP, which is growth at a reasonable price. Okay.
Oh, GARP. So, GARP? It's GARP. Right? Okay.
GARP. The wonderful world of GARP. So you and I were talking earlier about the fact that right now, amongst the executive participants that are 30, 40-year industry veterans that participate in my calls, right? I see three different categories: traditionalists who don't think that the semiconductor industry has changed very much, new agers who think that it's just totally different, and in-betweeners that think that it's sort of a little bit of both, right? And so if you look at it from a growth, value, GARP perspective, it's sort of that same kind of breakdown of three things, right? So with growth, people are like, for example, Tesla, right? Tesla has a larger market cap than the big three.
It's bigger than all the automotive companies put together.
All the ICE,
combined, the value.
combustion engine companies combined.
Yeah, the ICE companies, yeah.
And so you could make an argument that that stock is discounting 30 years out.
Yeah.
Right. And then you'll have a turnaround story or a slow growth company that's trading at like a single digit price earnings multiple that people think it's just dramatically undervalued. And that sooner or later, somebody will wake up and say, gosh, that's not right, and all this money will pour in, right?
Yeah.
A lot of value investors wait for years, and nothing ever happens.
Yeah, yeah.
Right? So never underestimate the herd mentality or the willingness of the crowd to just glom onto the latest and greatest growth thing. And then we'll find out later whether it really makes sense or not.
Well, the fundamentals make sense, the first principles, and I think that's what all comes to basic startups. What the fundamentals are, what the process is there value in it, or are we just doing because there's a media play? A lot of because retail traders are more than ever in the market today because they have more access, easy access. So they also put some play in there that drives some numbers. But again, it's the whole demographic. You say coming back to the '90s, where you say you started, and going out to what it is today in the 2020s, it's completely changed. It's completely revolutionized.
And not to mention the fact that through COVID, with people sitting at home trying to figure out what to do with themselves, you've got a whole new generation of retail investors that are literally moving stocks, right? And they're not necessarily...
The Robin Hoods and all the ones out there. We've all heard, I think most people can hear it, all the Robin Hoods and the big plays of the AMCs and all these type of things that come into play. GameStop, they are big drivers to these stocks that... Yeah.
How many of those people, which are literally moving markets, right? How many of in aggregate, how many of those people are building spreadsheets, doing 20, 30-year DCF analyses, right? They're not doing it the traditional way, right? Somebody sends out a tweet, oh, this is hot, boom, all that money flows over there, right? So that's where the notion of don't underestimate how much money will glom onto a growth story without a ton of analysis, right?
Yeah, that's one thing comes back to also software has enhanced. So there are more tools back 20, 30 years ago that there's a lot of analog tools that had to be created and formulated to create simulations. Today, you can get any type of software that can show you what you used to do in the 90s, all the work that you had to do as an analyst to get all this data and show the simulation of what can happen. Today, one app can show you everything you want, and it makes you feel like a professional stock trader. And that's why I would say 90% of people have no idea, but there's a 10% that actually do a lot of and they get this software, they learn it, they understand it, and they understand how the markets, and they can play the markets. Day traders, they can play 5-10% swing a day. They know. And it's allowed, technology has allowed the retailers to have more access and knowledge easier to play again.
Right. And I also think that if you look at what's happening with crypto right now, you can make a clear delineation between the younger set that absolutely believes it's the way of the future. They absolutely believe it's here to stay, right? And then you look at the older set, like the Janet Yellens of the world, the people that run China, right? They're afraid of it, right? Yeah. And so you see these 60, 70-year-old super famous money managers get on TV and say, oh, it's a hoax, it's a bunch of garbage, right? But yet it just keeps going higher, right?
Well, the value, it's almost a $3 trillion market cap right now for crypto. So
I mean, from my perspective, you just look at it from a supply and demand perspective, Bitcoin, Ethereum, whatever, supply really doesn't grow, right? But if institutions are allocating 0 or a fraction of 1% to it, and they take 1 or 2% of what they have in gold or precious metals and allocate that towards crypto slowly but surely, you get the Cathie Wood effect, which is she thinks Bitcoin's going to 500,000 in 5 or 6 years, just because institutions will increasingly allocate more money to that asset class. Especially, and it's funny because, people were looking at regulation, oh, that's terrible. Well, actually, no, not really, because if it's done right so that it doesn't kill it, right, it makes it more legitimate, which then allows the institutions to increase their allocation towards it, sell that to their conservative clients, and that creates just more demand for a limited supply.
Yeah, and that's we're getting into the whole fundamentals. I mean, you can get down into it because what does the crypto operate off? Blockchain. blockchain, today how we transfer credit, give money back, it's very old school traditional systems. The blockchain has completely reinvented the way we can transact, we can trace, we can do, it's final sale, transactions done. You can track it, you can get it instantly. There's no credit, there's no bank, there's no middleman, there's no people making money on every single, there are miners that do there's a decentralized system, there's miners are there to break the algorithm, make sure there's no fraud happening in the marketplace, exactly. Right?
Why does it take multiple days for a stock trade to clear, right? Why does it take multiple days to take money from your brokerage account and put it in your checking? That should be instantaneous.
The clearing house, the clearing process,
right? That should be instantaneous.
Yeah.
But let me give you an example going back to what we were talking about before about portfolio managers and growth stocks versus value stocks, et cetera. Hedge funds, not so much, but mutual fund managers have benchmarks, right? It's usually an index, S&P 500 or MSCI Global Index or something like that, right? And long-only mutual funds are mandated to be fully invested, right? So success for them is beating their benchmark. Mm-hmm. Well, if it's a bad year and the benchmark's down 20% and they're down 18%, they declare victory.
Yeah.
But their customers have lost money, right? And so I can't even begin to tell you when I was an analyst how many times I would walk into a money manager's office, and it was probably like a down cycle in semiconductor industry, fundamentals in the stocks were sort of in the dirt, right? And I would say, look, when companies like Micron in the commodity memory market business report horrible numbers, they're losing tons of money, and the stock doesn't go down. Everybody's sold out. There's no incremental sellers, and at some point, fundamentals are going to turn, and there's going to be a wave of incremental buyers, right? That to me is the biggest buy signal on a cyclical group, right? Conversely, like last February, they were printing money left and right, right? And they report that, and the stock doesn't move. There's no more new buyers, right? It's an auction market, right? So these portfolio managers on the long-only side, they're trying to beat their index. And a lot of them, what they do is they literally mimic the index with 80% of their portfolio, and then they make concentrated bets with about 20% of it. And they're trying to beat the index by a couple of points. Doesn't sound like a lot of fun to me, right? Well, I can't tell you how many times I've walked in and I would say, I think you should buy Applied Materials because I think that in 6 to 12 months, the memory guys are going to start expanding capital spending again, right? And they would look at me and they would say, exactly what do you think the price of DRAM will be in 3 months? Which is an impossible thing to answer, right? And then they would say, thanks a lot for coming. We're not going to do anything. And then a month later, something would happen to indicate that the cycle is turning on, right? The same people, analysts and portfolio managers, would call me and say, give me a name.
Yep.
Right? And then they would put it in their portfolio 5 minutes later with no analysis whatsoever. Whereas 2 months before, they had no interest.
Yeah, I
They're
totally
chasing performance. And the punchline here, that's why growth stocks are going to these crazy multiples. Because if you're a portfolio manager and you're not there, and that's driving the alpha, right? The outperformance relative to the market is alpha, right? If you're not there, you have to be there. So you're basically copying what the other people are doing just to be there. And then as more and more people do that, it just drives the multiples out of control.
It's like what restaurants or I say nightclubs or places do. They slow down the amount of people going into the venue to show a line. And when there's a line, everybody wants to line up to see what's happening. Should we go here? Should we invest? So it's like that simple analogy is like everybody just jumps. There's a line, so we should jump in there. We don't even know what's on the other side, but we're going to take the risk because everybody's going. And that's usually and today, as you know, you've been in this, a lot of even the greatest stock traders and analysts and the TV guys and Jim Cramer and all these guys, nothing makes sense. Sometimes the fundamentals that everybody's been working off for 50 years of the process they do, it's completely changed the last 2 years. The 2 years of trading and the retail traders has completely lopsided. And there's what they would have done of high risk, low risk makes no sense. They always bet, okay, don't bet, go here. This is going to be this stock is going to plummet. It's just the line's going up. It's going to plummet. All of a sudden, it keeps going up. There's going to be a crash. Nothing happens. It keeps going up. It keeps going up. It keeps going up.
Well, I think really, at the end of the day, it's very clear that the markets are not always right.
Yep.
okay, especially with individual stocks. So if you look at earlier this year, Intel announced a new CEO, Pat Gelsinger, right? That stock took off like a bat out of hell, and AMD got beat up for a couple of months, right? Well, then it started becoming clear to people that Intel's an aircraft carrier. It's not a PT boat, right? And it's going to take a long time to turn around.
To pivot and turn that thing, yeah.
Exactly. And then AMD started punching out these results that were just unbelievable, right? Gaining share, more share, better roadmap, et cetera. And Intel came back down. Intel took off, and or AMD took off. And so that was a window of time where the market totally had it wrong, and it happens, right?
Yeah. So let's go. Let's take this fundamental back to the 90s, since you've been part of it, and to what's happening today with the chip companies. Everybody for supply chain. Why we're in a supply chain disruption, right? Everything's challenged. Everybody says, okay, now it's between the wafers, shortages, and process. And what happened between the 90s and today that took these companies to go fabless?
So back in the mid 90s, when I first started researching the semiconductor industry, there were still a lot of companies like Motorola and IBM and AT&T, Bell Labs, Lucent. The semiconductor industry, Texas Instruments, in a lot of ways started by systems companies building their own semiconductor businesses.
Correct.
Right? And then that transitioned into what were known as integrated device manufacturers. That were kind of like Intel, AMD, right? Companies that were designing and producing their own devices, right? And then it morphed into what we call the fabless semiconductor companies. Xilinx was an early one there. Altera was an early one there. These are companies that focus on design and marketing, and they use contract manufacturers, also known as foundries, like Taiwan Semiconductor, to produce the chips for them, okay? And that really started proliferating in the late 90s and into the early 2000s, right? And then it got to the point where all of the original companies like Motorola just basically got out of the semiconductor business, right? And a lot of the fabless companies started taking significant share from the IDMs, right? Whether it was a technology transition or just more efficient, whatever, better designers, whatever it may be. And then what happened was, starting about 10, 12 years ago, the industry started consolidating significantly, right?
M&As, mergers happen,
all over, right? I mean, you look at the semiconductor equipment industry, there used to be, I don't know, like 3 dozen of them, right? Now there's really like a handful that dominate the entire industry, right? And so what has happened is you have fewer companies building capacity to service the same amount of demand. Memory is a perfect example, right? How many DRAM companies were there 20 years ago?
There was dozens.
Right? How many are there now? A handful. And they're significantly more disciplined with their spending, right? They're not. And one of the things that they never used to do that they do now is they literally have deep analysis of all the end markets that buy their products, and they're literally talking to every electronic systems maker in those end markets, and they're building their own forecasts of where they think the market's going to go. And they're building their capacity. It's strategic when you build a new greenfield fab. It's tactical when you slowly populate that empty building with equipment. There's a difference between installed capacity and slab capacity, right? Installed capacity is what percentage of the floor space is full of equipment. You could be operating at 100% installed capacity. That could be 10% of the building floor space. So what percentage of installed capacity are you, and what percentage of slab capacity are you, right? So what the memory companies and even the foundries now, what they'll do is they'll build a giant building. They'll populate it with 10% of equipment. And then as they see the forecast of the end market saying, we need this much more, they'll tactically add more
lines of capacity as they need. They'll grow it out.
Correct. And what the memory market is doing right now, and if you listen to Hynix or if you listen to Micron's recent conference calls, they are no longer building new buildings, new fab buildings, right? They're focused on shrink capacity expansion, moving from one process technology node down to the next, right?
To be more efficient in the process.
To not overbuild. To protect their pricing, to protect their margins, right? So there's been a progression towards consolidation, and it's resulted in more rational capital expansion, which has reduced the cyclical volatility of the industry. It's not gone. It'll never be gone, but that's the transition. And as a result of that lower cyclical amplitude, the let's say the industry used to be growing at like, say, 3 or 4% over a long period of time, right? Well, you'd have windows where it would grow 30 or 40% one year and shrink 15% another year, right? Well, you don't have that magnitude of swings now. And so that influx of predictability or lower volatility is one of the reasons why the valuations on chip and equipment stocks have gone up.
Yeah.
It's more predictable. Stocks love predictability.
Well, exactly, predictability, and also with their customers and technology that's being up to play, because everybody knows the last 3-4 years, I mean, of course, I keep going back to Mr. Musk. He drove, let's take one segment, automotive. He drove the market to go faster than they ever wanted to the EV cycle, and to go everything EV process, which at that point, in my opinion, of course, and how many components, people don't realize that the automotive sector only takes right now around like 10% of the semiconductors.
It's less than that.
Yeah, it's something.
It's like 5-6%.
Yeah, it's like, but it's growing exponentially.
Absolutely.
It's growing exponentially because the more cars are on the road, there's more components on the road. Right now, the only one that's at scale is Tesla. Everybody else is ramping technology to get there. But that just goes as one major industry that is in that phase of growth phase to completely change their model. And everything that goes, because in the ICE car, you can have sensors and process and you have fuel. But when you go to EV, everything is digital. There's components to everywhere. And then what charges it is component based. So everything, every indirect touch point of that process is, and then it's connected to a cloud. And then that's it. It's smart computing comes to that point. That's always learning the process and enhancing the software is enhancing the vehicle as it moves.
The biggest kind of slogan, if you will, that sort of in a nutshell explains the transition that the semiconductor industry is going through now that will drive higher long-term compound annual growth rates for the industry for the foreseeable future versus the last 10 or 20 years is the fusion of computing and connectivity.
Yep.
And you can also add sensing in there as well.
Well, it's IoT, every Internet of Things, everything needs sensor, yeah.
But the fact that it's all tied into the cloud, right? So you got edge computing, which is powerful in some cases, not so much in other cases, but it absorbs input from sensors, processes it, like an autonomous vehicle, for example, or the self-driving capability on the Tesla, right? But then it communicates that through the cloud into data centers, which drives demand for servers, increasingly sophisticated and application-specific servers, right? So this is the ball game where not only are you driving the historical trend in semiconductors of more content for each new generation of devices, right? But now you're fusing together. Computing used to be a silo, communications was a silo. Now it's all coming together, and that's driving the content through the roof.
It's like these companies have created a platform, and within this platform, everything can be connected when they build apps on top of it. So, I mean, that's a great analogy. The point is like everything is connected to a cloud. So there's these watches, smart watches, process, everything that even as a consumer holds on your hand could be connected and have some type of sensing that transfers data and then comes out, puts it to the cloud, comes back and tells you, okay, this is what's happening with your health. This is what's happening today. This is your schedule. This is the process. This is what's happening in your home. Your air conditioning is this way. Your smart, all the process, your doors open. They used to be all, I was going to say, automated. They're not automated anymore. They're all have automation and basically kind of machine learning processes into them that they're continuously evolving and learning. The system doesn't have to evolve. The system is just, it's sending, the cloud is sending information to it and telling it how to change. The brain sitting in the cloud through the edge to the smart computing to the machine learning comes back down into any device that we're working with today. And it's unbelievable because that's just the consumer and automotive. I mean, look at industrial, look at making every city smart, making everything that goes in those components, smart cities, smart process to make efficiency. Because at the end of the day, we want to reduce our energy spend with using energy and then reduce that to make it more efficient. So at that point, our lives are
I think a perfect example of what you're saying is that famous old commercial where the old woman is laying on the ground. She says, "I've fallen and I can't get up." Right?
Yeah.
That's now
Life
obsolete,
alert.
right?
Yeah.
If you have an Apple Watch on,
Yep.
it'll know you fell. It might even know why you fell, and it'll communicate through the cloud, and somehow, some way, there'll be a robocall to send an ambulance, right? So that's just one example of how you can take something that never even had a semiconductor device, and now it has hundreds or thousands of them to accomplish a particular task, right? Going back to EVs for a minute, there's something unique about EVs that hasn't always been a standard situation in the semiconductor industry, and that is that a lot of for example, I've heard commentary that an EV might have 10 times as many chips as an ICE car, okay? Now, a lot of the proliferation of those devices, whether it's on the charging side, on the traction side, on the ADAS side, the driving assistance.
Driving, yeah.
Yeah. Well, on the ADAS side, you've got a lot of very leading edge computing and communication chips involved. But, for example, you look at silicon carbide or gallium nitride, which is on the charging and traction side, right? Yeah. Well, those are produced on trailing edge wafers, on trailing edge process geometries. It's the material that is driving the transition, right? So, for example, microcontrollers are all over automobiles, right? They are not made with the most advanced process technology, right? So one of the things that's unique about what's happening right now is the semiconductor industry is short on supply, not only at the leading edge, but also at the trailing edge.
Trailing edge, yes.
And right now, the semiconductor industry at the leading edge produces chips on 300 millimeter or 12-inch wafers, right? 200 millimeter or 8-inch wafers was a mega cycle. Actually, the first semiconductor supercycle in 93 to 95 is when 200 millimeter wafers proliferated. That was the major transition from 150 or millimeter or 6-inch wafers, right? And ironically, in the 300 millimeter era right now, the equipment companies are selling more 200 millimeter tools than they did at the peak of the 200 millimeter era in the mid 90s. So that 14 nanometer, that 28 nanometer, TSMC just announced 40,000 wafer starts per month of new capacity for 28 nanometers in their China fab, right? And as a distributor, you know that microcontrollers are one of the longest lead time to active devices out there, right? Those are not produced at the leading edge. Those are produced at the trailing edge. But an EV is going to require a lot more of those than an ICE car, right?
Yeah, of course. And that, I mean, comes back to saying is the configuration of what's going on with the GPU, CPU, high-end technology is leading. And the biggest challenge, as we've discussed on some of these calls, is a lot of these companies that want to invest in, because a lot of these chip has like TSMC, Global Foundries, they want to go to leading edge technology because there is more value and there's more future, there's more money in it. The trailing edge, the costs have gone so low. I mean, they're trailing edge. The process is old-fashioned, and there's not enough money in it because there's penny parts, right? As you call it, they're low-end technology. For them to make those, they make traumatic high volume, and they rather move to the high end because that's really where things are going. And that's where the more value is at. Right. A 50-cent, a 20-cent microcontroller or a device or a driver, or 5 cents or a penny is nothing to them compared to making $50 to $100 to $500,000 FPGA processors that are compute that can go into some smart computing because there's more value and there's more money in it. And that right now is the biggest challenge, just like you said, is these companies like, oh man, we have to go backwards and reinvest with more capacity for the trailing edge, because no matter what, these trailing edge components are powering the leading edge CPUs and GPUs in the industry.
And they're reluctant to do that because they have new depreciation associated with that new equipment, right? Whereas before, they were producing those chips on fully depreciated equipment and they were just minting money, right? But just to give you a very recent example of a correlation between fundamentals and stock prices, how a stock price can be behind the curve and then catch up very rapidly, right? Qualcomm, okay? So for the better part of the last year or so, Qualcomm stock has been a little bit of a black sheep because people were concerned that Apple developing their own devices and pushing Qualcomm out of the RF front end, right, where they have a huge piece of business, would be a major drag on overall Qualcomm's revenue growth, right? And while this has been a big concern for people over the last year, Qualcomm has slowly but surely said, yes, but we have major diversification plans going on, in particular in automobiles and industrial IoT. And we are at the forefront of the fusion of computing and communications, right? And everybody said, yeah, sounds good, but I'm more concerned about you losing the Apple business, that socket, right, than this other stuff, quote unquote, that you're talking about, right? Well, a couple of weeks ago, Qualcomm reported terrific numbers with better than expected growth in their diversification categories, right? And then they did an analyst meeting last week, and they talked more about, in detail, all the different emerging applications in the fusion of computing and communications. The stock went from 120 to 170 in a heartbeat. And basically the whole consensus view on the story was one of concern to, oh, wow, okay, they can more than offset this loss at Apple over the next 5 to 10 years and really be at the forefront of the core fusion that's driving the accelerated growth rate in the semiconductor industry.
And that comes to a point where these companies, like Apple is building its own platform. It has its own platform. It's building its own chip. It's being vertically integrated. It understands that for it to keep growing, it needs to grow within itself. Qualcomm on that end know that, hey, we can't have all our eggs in only couple baskets that drive our growth. And I mean, of course, this must have happened years back. It's like, okay, we're going to and Apple makes decisions within, if you've ever worked with Apple, it's like 6 months to 1 year. The life cycle is instant. They just keep moving. They're very fast and they're very 2, 3, 4 years ahead.
Rob, that actually brings up a thought that when I was talking earlier about the progression of the semiconductor industry, I stopped at kind of consolidation and the fusion of computing and communications. But one area that I failed to mention that I should mention is that we're sort of going back to the future in a sense from the perspective that the semiconductor industry started at Texas Instruments and proliferated at Motorola, IBM, Hewlett-Packard. So the systems companies building their own chips, designing and building them internally, right? Well, there's a huge wave now of companies like Google and Apple and Amazon and Microsoft and Tencent, and you go down the list. Ford just announced the other day they're going to
build
design
chips.
their own chips, right? So there's this. So let's say you supply a microprocessor for a server, and it goes into what we call a general purpose server, right? Well, what's happening with all these different fusions of communications and computing is that the data centers are increasingly partitioning into application-specific worlds, right? And a lot of the data center providers want devices that are geared towards more efficiently handling specific tasks instead of trying to muscle in a general chip into making that happen where it's not optimized, right? And so the difference, though, so the notion that these end systems companies or users of systems like Amazon and Microsoft are getting into the chip designing business, that's a new phenomenon, but they're not building them. They're using the foundries to build them, right?
Correct.
So if you look forward for the next 5, 10, 15 years, okay, and you operate under the assumption that these types of companies are going to increasingly design their own chips and have other people make them for them, and that's going to be a growing percentage of the semiconductor industry, the EDA software providers hugely benefit from that, right? Because they're going to sell a lot more software licenses with continuous revenue streams, like a Costco membership card, right? That's huge, and so that would be like Cadence and Synopsys, right? And at the same time, companies like TSMC, they're going to be the ones that are going to build all these chips.
Yeah, well, that's why Intel is building, as their vision is, they're going to build out all these plants and offshore, put onshore into the States, build some more capacity, and they want to be basically a TSMC. They're going to have a division that's going to build, even though they're sometimes in the same business model, but they're going to build that we can handle capacity. We see the future, what's happening today.
Their challenge is they're behind the curve on process technology now, and they need to catch up. And if they do catch up, how much of that is going to go towards their internal needs versus their foundry business, right? And if they're trying to sell an x86-based processor to Microsoft, and Microsoft is designing their own chip to do a similar function, is Intel going to make that?
Yeah.
And if they do, they're going to have a lower margin on that, most likely.
It's a conflict of interest, as you would say.
They risk cannibalizing their cash cow. Right?
And that's the challenge of all the chip, because again, everybody, as much as they've gone fabulous, now they're thinking, okay, some big companies will reinvest, Samsung, all these guys will reinvest into making their own chips because they see the growth. The growth is there, the trajectory is there, the demand is outweighing the supply. Way more. I mean, as we get to the point of supply chain, and we get these chips, and all this conversation we are at the end of the day is why? Is because the demand is outweighing the supply. It's not that COVID is because the supply is constrained. It's because COVID has ignited and set us on a trajectory that has increased the demand for components across the board.
It's accelerated the fusion of computing and communications. Right now, if we look at the here and now. I started with BWG Strategy in January of this year, and my job, I'm a moderator. That's my title, right? And so I moderate conference calls. I do 6 one-hour conference calls a week, and usually 3 or 4 on semiconductors, the whole ecosystem, right? And then the other ones are on the solar industry, residential solar, utility scale solar. I also do some 5G test and measurement. And I do aftermarket auto parts, kind of random. But anyway, so typically the way this works is BW Strategy's shtick is no bias, right? So if you look at the traditional research model on Wall Street, whether it's from an investment bank or what have you, the analysts have ratings, buy, hold, and sell. And they're involved in investment banking, right? So there's always a bias to their recommendation, okay? And companies, through their investor relations operations, are typically highlighting their positives and ignoring or not really talking too much about their negatives unless it's so obvious they have no choice, right? So the general concept is that money managers, whether it's an analyst or a portfolio manager, spend the majority of their day being lied to or misrepresented to, or just listening to the glass half full side without really getting the balance, okay? And so where the founder of our company saw an opportunity was, let's eliminate the bias and it all started with in-person roundtables in New York City where a group of executives would show up and a group of investors would show up, and the moderator would just moderate a discussion on industry fundamentals. And so it would be a deep dive into what's happening in the industry. There was no talk about stocks, no talk about valuation, right? And so the investors could take that back and work that information into their perspective that we were talking about earlier about the bull case versus the bear case and where they think it's trending, right? So it's all about unbiased primary research. That's
and it's talking to the foot soldiers on the ground who are daily, and that kind of can give you the full 360 viewpoints instead of just the numbers of really what they see and what's happening on a day-to-day basis.
That's exactly right. Now, in a traditional Wall Street model, an investment bank would have a trading desk, okay, and they would have an equity research department, and they would have an investment banking department, right? And so the revenue model was they would make money on trading. And usually what would happen is that the money managers would rank each firm on Wall Street in terms of how much they value the research department from 1 to however many they were. And then for the next 3 or 6 months or a year, they would distribute the market share of their trading like an upside down pyramid. So the company that was viewed as providing the best equity research would get the most trading volume, right? And then it would trend down from there. And then the deals, like let's say you're doing a lot of trading volume. If that investment bank gets a deal, you're a better customer than somebody who's doing less trading volume, so they get more allocation on a deal, right? So sometimes the trading volume was predicated on how much deal flow you want from a particular broker, right? But typically the way that the buy side would pay the sell side is through the trading desk, okay?
Yeah.
Now, the founder of BWG Strategy realized that when you're a rounding error research provider it's extremely difficult to get a buy-side firm to allocate trades to you to get paid, right? Because research is something that everybody wants, but nobody wants to pay for because it's not tangible, right? So what he did is he created a model where each pod, which is a portfolio manager or a fund in a large organization or an individual smaller hedge fund, would pay a yearly fee, like $50,000, right? And they can dial into as many of these conference calls as they want throughout the year. So you save money by not having a trading department, and you ensure your revenue, right? So there's no bias to the research flow, and there's no cost structure around a trading desk.
That's, you know what, extremely fascinating. Extremely fascinating of how that works, because again, you're right, the tangible things of information is money, but some people don't want to pay for it.
That's right. Now, the beauty of the business model is cost of goods sold, which is the valuable information that our clients are paying for, is zero. Because people like yourself that participate on these calls are not paid. It's voluntary, right? But so how do we convince people to be regulars on these calls, right? Well, it's a sharing of information that is valuable to the participants as well as the listeners, right? And as a moderator, my job is to drive the conversations in a way that the executive participants gain knowledge as well as the institutional investor clients, right? And a lot of the companies like yours, for example, right? Do you have a competitive analysis department? No, you don't, right? So a lot of the people that participate on our calls are consultants, manufacturers, reps, smaller company people that where is their daily inflow of market intelligence coming from? They dedicate an hour a day, or I'm sorry, maybe a couple hours a week to listen to these calls, and they're in touch with the pulse of what's happening in the industry. So that's the value-added proposition for the participants, right? And so over the years, BWG Strategy has built up a database of executive participants. And so one of the things we do is every couple of months we send out a survey, and we'll ask pertinent questions about where's the industry, where's it's going, right? And we typically get a 1 or 2% response, right? So if you send it to a large number of people and you get 30 or 40 responses, that's good, right? And then we publish what we call insight reports. So we're mining the database of executive participants, right? We also have a separate division, which is called BWG Talent, which is a headhunter firm. And so somebody will give us a mandate, and we will mine our database of executive participants and either find somebody a better job or get a referral to somebody. Right? So we've been able to use this database of executive participants to grow the core business, which is the primary research business, the conference calls, right? And then morph into a couple of other different divisions.
It's extremely fascinating for someone outside the realm of that type of analyst information to the trading, because again, it all goes, people say, to the street, to Wall Street for the trading. And there are people that want it. And again, the pulse of the people, what is happening on the ground? Because people always say there's a disconnect, right? What's really happening on the ground? What's happening supply chain? What's happening in manufacturing? What's happening daily? What do they see? Especially in this unprecedented market that nobody knows, that we talked about, is unprecedented super cycle of what's happening. How can people make a better decision of trade process, what they're going to invest in, what they're going to do, if they're only getting one, as you say, one side of the story?
That's right. Now, one thing to consider, though, is, for example, if you contemplate technical analysis, which is chart analysis of stock movements in the past, to try to kind of get a sense as to how does a current chart pattern look relative to historical ones, and based on the past, where should that be going? Okay. So in a lot of ways, understanding the past helps you in the present. But on the other hand, industries change, technologies change, things change. Really, no two cycles are exactly the same. Okay. And so, for example, in the August timeframe, there was a weakening of memory market fundamentals, right? DRAM prices, which had been going up all year, started to go down, right? Well, historically, that's a major smoke signal that there's a potential cyclical downturn fire brewing beneath the surface, right? And so chip and equipment stocks actually had a little period of weakness when that first emerged, because the traditionalists viewed that as, oh, this is a major smoke cycle. This is smoke signal. This is the beginning of the end, right? Now, when Micron reported shortly thereafter in September, they guided their bit shipments down slightly for the December quarter. And everybody's thinking, how is that possible, right? And what they said was, a lot of their customers were not able to get a small number of specific devices that have 50, 60-week lead times in order to finish acquiring the bill of materials to finish producing an electronic system. Therefore, they said, well, memory is more valuable. We sort of have enough right now. We're going to hold off on that for a little bit until we can get some of these golden parts in.
Correct.
Right, to finish our builds, right? And so the market kind of said that is a standard rationalization that we've heard in the past that then becomes a little less confident to the point where, oh, we were wrong, it's rolling over, right? Well, then subsequent to that, in October, right, 20 companies all popped up and said the same thing, right? And the market started realizing, oh, yeah, that was a little weakness in a segment, but it was not actually indicative of a cyclical rollover for the industry. And then the stocks took off, right? And what we've seen is with NVIDIA, with AMD, with Qualcomm, that companies that are perceived to be better positioned to see accelerated revenue and earnings growth looking forward from this kind of fusion of communications and computing and exposure to EVs and whatnot. Select companies, select stocks are outperforming the group average because they're perceived to have some sort of edge. Like NVIDIA dominates the graphics processing market, and nobody really sees a viable threat to that now. AMD has a roadmap of executing to their roadmap on CPUs, microprocessors. They have a power efficiency advantage right now, which is increasingly important to data centers, and they're gaining share like crazy, right? And people believe that it's going to take Intel years to catch up, right? So that's a story that's perceived to have open field running, and so it's outperforming the group average, right?
Yeah, I mean, overall, you look at it, all the average, these top, like the NVIDIA, AMD, I mean, what do they have in common, in my opinion, is a lot of them are building platforms, right? That's what a lot of people didn't realize.
Actually, it starts with great management.
Yeah.
Right? They put forth a strategy, and they tactically executed their strategy, and they have leadership, but they have dominance. I mean, NVIDIA has dominance, right? AMD is not necessarily dominant from a market share perspective, but they're becoming increasingly dominant in a segment, which is the data center segment.
Correct.
Right? And they have that, the ultimate of all achievements for any particular company is a sustained competitive advantage, right? The old Michael Porter from Harvard thing, right? And if you actually can convince the investing public that you have a quote-unquote really good moat, which is slang for sustained competitive advantage, you will get a disproportionate amount of money flowing to your stock versus others in the group.
Yeah, which allows you to grow. And then we come back to that, the management, what they're building, because again, there's going to be a big companies, the Googles, the Apples, the Amazons, the NVIDIAs, all these companies have, yes, they have great management people, but they realize that they need to build platforms that then tens of thousands of other companies are going to use to build on top.
That's correct. Now, if we look at the here and now on the supply chain constraints in the semiconductor and the entire ecosystem, from shovels in the ground, mining materials, all the way through your business, which is electronics distribution, right? There's a whole ecosystem between all that, right? Okay, so this calendar year, in January and in February, most of the 30, 40-year veterans that are the executive participants in our semiconductor forums were postulating that, by the second half of the year, we should have a handle on these supply constraints, right?
Yes.
And in the March, April timeframe, that pushed out, right? It's looking like maybe early 22, right? And then again, recently, it pushed out again, right, to the point where people are saying on these calls that maybe in the second half of 22, these unprecedented lead times will start to shrink, but we won't see normal lead times until well into 23, right? And even some people are suggesting 24. Yeah. And our friend Gil is, yes. I think he says it's permanent, right?
Yes.
So it's been stretching out, right? And so that's the reason why the stocks, which were sort of in a kind of sideways trading range from February into the recent past, because they just didn't know if next year was going to be a really good up year or rollover, right? And in the last month or so, the notion that there's not going to be a cyclical decline next year has sort of become the preponderance of the view. Mm-hmm. More people than less think that, right? So we've sort of had, in a pretty good market, we've seen the semiconductor stocks break out into a new higher level.
Well, that comes to the point where allocation shortages cause inflation and price increases. And this year, myself, I've probably seen a dozen companies put not one price increase, not two, but 3 to 4, even every quarter, a price increase of their chips or of the can be a chip, an indirect material, a passive component. They're putting price increases. But again, their demand hasn't slowed down. Their demand is, they're 100% plus capacity, but they're still putting price increases in.
I mean, you yourself, Rob, said in one of my calls 3 or 4 weeks ago that after a little bit of sluggishness late in the summer, in the August timeframe, that fourth quarter demand is greater than you thought it was going to be. And that commentary was a microcosm for the entire industry, right? And so, and this is something we heard about earlier in the year. That's just kind of like, well, let's say capacity in 3 or 4 quarters can catch up to current demand. Current demand is not stationary at all, right? So it has to catch up to that. Yeah. Then it has to catch up to the growth in demand. Then it has to get to a point of excess, right? And all year long, the distributors, especially like, for example, the line card distributors, World Peace Group, Arrow, Avnet, et cetera, they've been saying all year long that they have so much backlog that every time they get shipments, it goes right out. Yep. They're not building an inventory, right? So there's been clear indications in the last month or so that instead of a holiday season, post-holiday season build slowdown and the potential for a rollover, it actually looks like it's actually getting tighter, and the demand side is just tremendous. And one thing that we heard this past week is that the back end, the chip assembly and packaging area, is, for example, our friend Chris Wynn, he's looking at like 50-week lead times for the dicing saws from Disco, right? That's unprecedented, right? It used to be, it was so much easier to add capacity in the back end than the front end. And so there's a concern now that if the front end guys catch up with demand, maybe in the second half of next year, that the back end guys are still going to be a bottleneck because their margins are lower and they got off the schneid later to expand because they're more nervous.
Correct. I definitely agree with that. And it is because some of our key customers to know that are building systems or power supplies or systems that are going into these front end or back end machines, right? Their business, their bookings for next year, I've got some calls because they're preparing us to say, hey, we need you guys to stock, to do whatever you can to get, because we're going to have a 50% growth. We're going to have 80% growth. Our bookings are there. Everything is out there. So what are we going to do? They're asking us, hey, what are you going to do to be able to supply to us as one of our key suppliers to be able to give us the, and that just tells you on the street, the demand is there for the infrastructure, and people are building more and more infrastructure for industrial semiconductor output, logistics, process components than ever. And because the demand is still there. But again, we don't know what outside forces could change a directory between natural, because again, we didn't get into the pandemic. We had chip factories burned down. We had floods, we had weather, we had freezing, we had all these things that kind of we forgot about that also were a point of slowing down the supply chain. And then we have logistics issues because systems are traditional, they're not digital, no one communicates, we have politics in place. There's so many outside forces that are causing this. It isn't just one thing of supply chain for components. There's a lot of other things, and who knows what we're in store for for the unknown in front of us.
Russia invades Ukraine and China thinks that's our cover to invade Taiwan, and all bets are off.
Yeah, so there's a lot of unknowns, and we're all trying to bet on the future. But again, in the component, you can't complain the demand is there, but there could be certain outside forces that could change the direction.
That is true. But now going back towards core fundamentals, in my calls over the last year to date, let's say, I've sort of categorized, I touched on this earlier, I've categorized the executive participants, many of which are 30, 40-year industry veterans, into three categories: the traditionalists, the new agers, and the in-betweeners. Okay, the traditionalists see the semiconductor industry as supply-driven. Yeah, there's some new demand drivers, but, at some point there's going to be an overbuild of supply. That's going to drive a downturn, and it's the same old story, right? And there will be a downturn. It's just a question of how deep it will be.
And when.
And when. Right, and when. The new agers, of which you're clearly in that camp, and it's interesting because the distributors are almost all in the new ager camp, and they're on the front lines dealing with the buyers screaming for chips, right? They're of the opinion that the breadth and depth of new demand drivers is unprecedented in the history of the industry, and it's a sustainable trend, and it's going to drive a long-term increase in the secular growth rate of the semiconductor industry from, call it mid-single digits to high single digits, 10% range, right? And then you got the in-betweeners, which is where I am, that recognize the dynamics associated with both the supply-driven side of the industry historically and the new demand drivers, right? And we hear a lot of talk on these calls about distributors talking about non-cancelable, non-returnable, and fabless companies, or even companies with fabs that use foundries, signing long-term supply agreements that actually include, for the first time, a progression to newer process technologies and price increases baked in, right? Well, I did a call 2 days ago where a buyer of foundry services, of chips, right, basically said that 2 years from now, if the pricing in our long-term agreement is 50, 60% higher than the market price, there's going to be a renegotiation, right? So the notion of non-cancelable, non-returnable, it sounds great, right? But in every downturn, it all unwinds, right? Yeah. And so I actually think that as an in-betweener, I do believe that the secular growth rate on the demand side is unprecedented. The breadth and depth of demand drivers, the fusion of communications and computing, sensing, et cetera, the proliferation of chips everywhere. Okay, yeah, I'm a believer in that, okay? But I'm also a believer in the notion that this is going to be awesome until it's not. Yeah. And there's going to be a rude awakening out there, but I just don't think the depth and the duration of the next downturn is going to be like some of the worst swings we've seen in the past. Yeah,
and a lot of companies, on top of that, there was a lot of companies who have been developed, of startup companies 10 years ago. And there are billion-dollar companies today, or $100 million companies. They're building technology, but a lot of these people working in those companies have never gone through the cyclical component shortage, right? So that's one thing that no one foreseen a lot of this, is these are new talent into the industry who have never seen this type of upswing, downswing, or cyclical, or excess, or NCNR. They don't believe in it. There's a lot of people, what is this? They're just buying components to build because they have a demand for some product, and there are thousands of these startup companies who are building these products who's never experienced it. All they're doing right now is we just have to build because they're either startup funded, they're going public, or they're whatever they're trying to do. They try to raise money and they don't know what is going on. And this is one thing, is the lack of experience in supply chain between the traditional and the new school generation. There's a gap there, and it's also causing an issue within supply chain, within what we can forecast, what we can do, and how we buy and how we procure components for everything that we're trying to build. And then that's in every industry.
Now, on the other side of the coin, there was some commentary in one of my calls this past week that the system's significantly more automated than it used to be.
Yeah, it is more data-driven.
More data-driven.
More data-driven, more processed, more, because the smart systems, if you go in the SAPs, the Oracles, all these great ERP systems, and then they have module-based where they're building developer apps that can predict, or can predict things. Of course, the top EMS companies in the world have these systems. The new guys don't. But again, it's input is output. If you can't input clean information, the output's garbage in, garbage out. So still, there's a tradition, and there's also a mitigation of gap between, even though this leading edge company who's a startup has all these systems, their supplier or all their indirect suppliers are all traditional. And they can't connect.
Algorithms are designed by people.
Yeah,
right.
You're right.
And there's good algorithms and there's bad algorithms.
And that comes to the point of, and even logistics era and all the stuff with traditional transaction based, is that's really where we see is there's a lot of bottlenecks, because this year is not just a year of innovation of technology. It's also software, where people have to reinvent their companies to be much more data driven than ever. Just you come from Wall Street, you're talking about data. But B2B business, really traditionally, was traditional buy and sell, purchase order, sales order, this process. They really didn't collect as much, our sales numbers are doing well, this is good. But they didn't get down to the micro, the finance, pricing analyst, the process. There's very few, I would say 10% of the companies out there do it, 80, 90% do not.
And you bring a good point, software. And I didn't talk about this earlier, but a lot of chip solutions now are not just chips, right? There's a lot of software involved. It's a package, it's a platform, right? And if you can deliver a platform to someone, it speeds their time to market.
Yes.
And it makes you more valuable and more sustainable as a supplier, right? So NVIDIA is a company that has an unbelievable software environment or ecosystem around its graphics processor units, right?
They have a platform around it.
And so, as people are, looking at who they want as a potential supplier or who they want to put money into as stock or whatever, it's that platform sale versus the hardware sale that can make or break the market share, right? And you look at the Apples and the Amazons and the Microsoft and the Googles that are designing their own chips, right? They're not designing the chip and then figuring out how to do software later. It's almost the other way around, right? And so that's a very interesting trend. It's more sophisticated. It's more complicated. It requires a lot more smart people, which is why we should be sending out a lot more visas for smart people. We should be the brain drain absorber.
Well,
right?
I mean, that's a whole other side of what's happened in the world with the social media and all the things of instant gratification, but that's a whole different topic. But, getting into but closing this up, I want to ask you one thing, because I asked, if, just two questions I have for you. One thing is, if you were yourself, say, looking at yourself now, back, say, 20 years ago in your career, what would you tell yourself?
Don't waste time on long shot speculative companies. Stay with the leaders. Grow it slowly and steadily. Don't be impatient.
Yeah. And then my other next question is what's your message to the new generation out there?
Well, I think that my message to the new generation is get as much education as you can, have a work ethic, and realize that you're not going to go from being a student to a CEO in 5 minutes, right? This whole concept of the entitlement thing, right? You got to build it up. You got to build it up. You got to be patient. You got to build it up. You got to build it up. But, unless you seek higher education, unless you seek more responsibility, unless you increase your knowledge base, you're not going to get the big bucks, right? You got to grind it up.
And what I say is you always stay curious. Curiosity is what will drive you to keep learning. Never stop learning, keep moving forward and driving that. And that's the number one thing. And get your hands dirty, because it is we're going to hit some walls. And that's the number one thing is today's generation is if they hit a wall, they kind of give up. They don't realize that, hey, you can go over it. I made an error. And that's the thing, keep it moving forward and building on top of that. And that's the biggest thing, as I say, coming to that's keep driving forward. And
don't let a hurdle stop you, right?
Yep.
You can either jump over it, walk around it, plow through it. Don't let it stop you. Just keep going. But you have to have a plan, right?
There has to be some objective we're trying to reach. Yeah.
If you're running a business, right, you want a strategy that works, and then you want tactics that work to the strategy, right? Well, in your own personal career, you should be thinking one or two jobs, at least two jobs ahead of where you're at. Yeah. And how do I get there? What's my personal plan?
Basically, I always say there's a why and there's a how. I always say come up with a why, and then the how is how to execute it. That's what it is. If the execution is key, you can have the why, but if you don't know how to execute it or try to execute it, it's just going to be the why.
A lot of people are dreamers and don't want to do the hard work, but it's closing the gap between the vision and making it real.
Yeah.
Those are the people that are successful.
Well, amazing. Jay, you're full of knowledge, and man, we can go forever into other holes, rabbit holes, I would say. Thank you so much for coming on the Real Talk. Thank you for sharing your experience, your knowledge, taking us back to supply chain, and actually what you do every week on the calls. And I really enjoy being on them, and thank you for actually having me as a guest on them, and look forward to doing this more with you.
Fantastic. Thank you, Rob.
Thanks.